This conference will now be recorded.
Okay, all yours, Commissioner.
Okay, good afternoon, everybody. I'm calling the meeting of the Deployment Committee to order at, looks like 2:04 p.m. on November 17th, 2021. And is there anyone here today that would like to provide any public comment? Okay, hearing none. I think we can move on to our next agenda item, which is approval of the meeting minutes. Is there someone on the Deployment Committee who would move resolution 1, motion to approve the meeting minutes of the Deployment Committee for September 22nd, 2021?
This is Matt, so moved.
Shandy, seconds.
All those in favor?
Aye.
Aye.
I need
Any
to abstain, Sarah, because I was not here.
Okay.
Yep. Same here. This is Dominic.
Great. Anyone else? Any other abstentions? All right. Great. Resolution 1 approved. Next we have an update on incentive programs from Joe Buonanata and Sergio Carrillo.
Yes, good afternoon. Good afternoon, everyone. I just wanted to do a quick introduction of Joe Buonanata. Joe is the person who helps us manage this Smarty loan program that provides low interest rate access, low interest loans to homeowners to make energy efficiency and clean energy improvements to their homes. Joe will be presenting an update on the Smarty program, the use of ARA funds, and the future role that the Smarty program will play in environmental infrastructure. So without further ado, Joe, please take it from here.
Thanks, Sergio. Good afternoon, everyone. Thanks for having me. It's good to be with everyone. I am going to spend just a minute giving a quick overview of the Smarty program in case there are folks on the line that might not be familiar with it. So the Smarty loan is the Connecticut Green Bank's residential financing program. It is administered by the Green Bank in partnership with 9 local lenders. So 1 CDFI, Capital for Change, as well as community banks and credit unions, all covered throughout the state. And we have a network of about 350 eligible contractors across different industries. This is a program that homeowners can use to finance upwards of 40 different home energy improvements, ranging from measures like battery storage to electric vehicle chargers, health and safety measures like asbestos and mold remediation, windows and insulation, heating and cooling measures, and solar. So really it's very comprehensive in terms of anything that can save a homeowner on their fuel or their electric bills. The loan amounts that are available through Smarty loans are range from as little as $500 to as high as $40,000. And there are 4 rate and term options with the term tied, with the rate rather tied to the term that the homeowner selects. 5 years to 12 years, 4.49 to 6.99. This is an unsecured personal loan, so there's no lien put on the homeowner's property, no collateral that's necessary. It is applicable to owner-occupied properties and 1 to 4 unit residential, all throughout the state. So this is not tied to utility program. One of the main other options under the Energize Connecticut umbrella, along with the Smarty loan, is administered by our partner Capital for Change. That's the Connecticut Heat loan, but it's only available to homeowners in United Illuminating or Eversource territory, whereas Smarty is available statewide. So we see lots of loans done in Wallingford or Norwich and other areas where there's a municipal electric utility. There is no money down required with this program. There are fixed monthly payments, and there's never a prepayment penalty for homeowners who want to pay off their loans in advance. And we do have a carve out for up to 25% of a Smarty loan applicable or allowed to be used for what we consider other or related energy measures. Those are things like electric service upgrades in advance of installing solar or a heat pump, tree trimming to accommodate a solar project, even things like Energy Star appliances. And then the next agenda item, this one will be focused on area restructuring, but the next agenda item will be talking about environmental infrastructure. So I'll talk a bit about the change in what that 25% category could potentially look like moving forward. So next slide, please. This is a brief overview of who the lenders are that participate in the Smarty loan program, and then the 2 term sheets that the lenders have signed up for. So 5 of our 9 lenders have agreed to what we call our credit challenge term sheet. The underwriting criteria for this term sheet is a 580 minimum credit score, a 50% debt to income ratio maximum, with that debt to income screen waived for borrowers with a 680 credit score or greater. So broad applicability with that underwriting criteria. 4 of our community banks, they're a little bit more conservative in their underwriting, and so they require a 640 minimum credit score and the 45% debt to income ratio maximum. And what you see in terms of volume is that the majority of our volume is with the lenders who are under that credit challenge term sheet. Next slide, please. Just a brief update in terms of program to date statistics. So the program launched in May 2013. We launched on an early morning, Bert can tell you, in Norwich, in partnership with Norwich Public Utilities, Core Plus Credit Union, and Eastern Connecticut Savings Bank, and a handful of Norwich area based contractors. Since then, we've closed nearly 6,000 loans for just over $88 million financed, with the average loan amount being just over $15,000. Where we see the majority of our volume with Smarty programs, Smarty projects, is in the HVAC space. So traditional heating and cooling like boilers and furnaces, but also more recently, lots of heat pump projects, air source heat pump projects, and even an increase in geothermal over the last year or two. The average credit score for a Smarty loan borrower is about a 744 with an average DTI of 18%. And in terms of loan performance, we're proud to say that the portfolio is performing very, very well. Just over 1.5% delinquency rate. This is based on loans outstanding, loan count outstanding, default rate of just over 0.25%, and then a charge-off rate of 2%. So really healthy portfolio that we attribute to the homeowners seeing real financial savings with the energy projects that they're installing, and then applying those to pay back their loans. Next slide, please. All right, so that was the background on Smarty. So the actual notice, and this is kind of the next 2 agenda items are unique agenda items in that they're not anything that we're asking the committee to vote on, but mainly just letting you know of an upcoming proposal. So in 2012, the Green Bank repurposed just over $8 million of American Recovery and Reinvestment Act funding from grants to support financing programs through credit enhancements. They were namely loan loss reserves and interest rate buydowns. In 2017, the Deployment Committee and the board of the Connecticut Green Bank approved a reallocation of about $5 million from loan loss reserves of these ERA funds that were in loan loss reserve accounts. They were reallocated or repurposed to Smarty interest rate buydowns. And so what we would do with the Smarty loan is use ERA funds to run what we call special offer campaigns. And so an example most recently in this spring was an interest rate buydown campaign of 1.99% for our 5, 7, and 10-year loan terms. So the Green Bank was using the ERA funds to buy down the interest rate of a 5-year loan, for example, from 4.49% to 1.99%. And we also had a carve out of 0% for borrowers who were at or below 80% area median income. And so we were using those ERA funds to buy down the interest. So we would prepay the lender at loan closing the interest that would have typically accrued over that loan period, so that they could close the loan at the lower rate. And those special offer campaigns always resulted in lots of interest in the program, brought on new contractors, brought in lots of interest from homeowners, and lots of closed loans. And we've always tailored these special offers to focus on projects that support the state's comprehensive energy strategy, the state's climate change mitigation goals, so heat pumps, general electrification, battery storage, geothermal, and so we've seen lots of success in deploying those ERA funds through these buy downs. So the 2017 reallocation basically took the $5 million from the loan loss reserve accounts of other financing programs that were just sitting in those accounts and moved them. We replaced them with Connecticut Green Bank funds and allowed us to deploy those federal dollars through Smarty loans. To date, so through November 2021, we've deployed about $7.5 million of those ERA funds across just under 3,000 loans. What we're anticipating doing for the next deployment committee meeting in February 2022 is to make a formal request to this committee to replace the remaining ERA allocation that we have, which we believe, and we'll present, of course, firm numbers in advance of that next meeting. But we believe it's about $800,000. That's about $600,000, and Jane can jump in if I misstate any of this, but about $600,000 of funds that are in loan loss reserve, as well as additional funds that have accrued interest over the years that they've been in those loan loss reserve accounts. And so what we anticipate doing is bringing this to the committee, just like we did in 2017, to repurpose those remaining ERA funds with Connecticut Green Bank funds, and then launching a final Smarty campaign with these almost 10-year-old ERA funds and deploying them to support new clean energy technologies. Brian, would you like, I don't know if you'd want to open it to questions or...
Yeah, any questions, comments? Well, just one question, Joe, for you. In hearing you present these slides, I was wondering if you might not, or Bert, delve into a little bit on the fact that the lenders take the first 1.5% of losses and we're a second loss, just to give, I think the deployment committee members understand that we're not doing the loans, we are guaranteeing the loans, but maybe give a little bit more of that background context, I think would be useful.
Yeah, sure, I can do that, Brian. Can you hear me?
Perfect.
Okay, great. Yes, the whole structure of this loan program derived from the fact that we were not the first ones to come up with the idea of a loan loss reserve helping to promote residential energy efficiency and solar PV loans. But what we recognized was that when state or utility programs were issuing these loans, it presented the problem of needing to constantly come up with a source of capital, and one of those sources of capital could be from the state coffers, or from a limited pot of money that would need to be replenished. And some programs thought of securitizing loans, but those created their own challenges. So we decided to try to do a different approach, which was to first of all involve our local banks and credit unions, knowing that they are a good source of funds for transactions being funded in their community, be they car loans or home improvement loans or any other kind, even mortgages. And if we could entice them into doing these transactions, then we would have literally an infinite source of capital available to us. So the special arrangement, if you will, that we came up with was to not do a first loss loan loss reserve, but a second loss loan loss reserve. And the concept behind that is that banks are in the business to make loans. They, as a part of that process, they expect to recognize some losses over time. That's just happens that goes with the territory. So what we wanted to do, and our proposition to the banks, was that the Green Bank will insulate you from exceptional losses. And we peg that loss rate at 1.5% of their portfolio loss. So if the bank or the credit union lost more than 1.5% on their portfolio, then our loss reserve would then kick in. for an amount of loss up to 7.5%. So this was very attractive to the banks and and credit unions, and they did sign on. And the level of loss experience for the Green Bank in our loss reserves has been quite minimal. The banks have booked approximately 85 million, I think was on your slide, Joe, and we've recognized maybe around $100,000 of losses, so to the loss reserve. So meaning that these loans, as Joe has discussed, have performed very, very well. So it was an interesting and new approach to the concept of the loss reserve. The banks clearly love the program. They're active participants in the program, and we do what we're supposed to do in terms of qualifying all the programmatic aspects so that the banks can do what they do best, which is to lend. So if there are any questions, happy to take them.
I do have a question. And I'm sorry, Joe, you may have had some information on this, but I'm wondering what's the disbursement of the loan among people of varying income levels?
Sure. So we don't have, I didn't have a specific slide with data on that, but I'm happy to pull some statistics and we can share it. We do see in terms of the credit score side, the average credit score is the 744 number. So we are still seeing that even though we have this this credit challenge term sheet, the majority or a large part of our volume is still in the plus 700 credit score area. It's a major focus of the program team to focus on LMI homeowners and outreach through other on the ground partners like Sustainable CT and different campaigns, and then our contractor and lender base to reach more customers. But happy to provide the follow-up data if you'd like.
So I guess one of the questions thank you for that. One of the questions I have is whether we think that the underwriting criteria as far as the debt to income ratio or any of that is that standing in the way of people of more limited means participating? And so I would like to know, how our participation breaks down by income level. I'd also like to know if there's any way that we can leverage some of this additional funding to help, write down some of the other conditions to make it easier for people to participate. I'm not sure if that's possible, but I'd like, I think it's worth thinking about.
Yeah, I think Joe, I think when you pull those statistics, it'd be helpful to also pull the statistics on approval rates, which are actually quite high compared to others. I think they're in the 75 or so percent level. So and quite honestly, we're dealing with regulated financial institutions that have their credit box and such with debt to income kind of requirements, which is ultimately for the protection of the borrowers so they don't get in over their heads and they can be good borrowers. However, having said that, we do get requests for exceptions, and this is because these local lenders know their communities and they know their borrowers, and they want to help them as much as they can. So periodically we do get requests from the banks that can we exceed the debt to income ratio standard, and so on. And we generally just ask them for what's the basis for their request, meaning why do they feel that it's warranted, and they'll usually give us a few sentences on why they feel the customer is good for it. And I can't, quite honestly, I cannot think of an instance where we've received such a request and have denied a request, because it's usually, well-founded, as you would imagine, coming from a bank.
Sure. And I know the premise of the loans is that, I mean, we're giving people these loans, but we're also reducing their energy costs. So there may be some, opportunity there. Just, would like a little more information on that, especially, how, who's participating in the Smarty loan by income. So that would be fantastic if you could share that.
Just really quickly, Commissioner, on that, we'll point it out as a follow-up, but in our recently approved annual comprehensive financial report, we do include a breakdown of programmatic kind of distribution. I don't know if you all can see this, but this is the Smarty loan page by vulnerable communities. Vulnerable communities statutorily has a definition. Essentially low to moderate income families, communities that are eligible for CRA, the Community Reinvestment Act, which is essentially less than 80% area median income, or environmental justice communities, which is DECD determined distressed, or those less than 200% of the federal poverty level. So with that definition for the Smarty loan program, what's vulnerable, we have about 41% of projects are in vulnerable communities. In terms of clean energy deployed beyond efficiency, we have 27%, and then total investment is about 34%. So we're working towards a goal of no less than 40% of investment in vulnerable communities and benefit by 2025. So we are tracking it. There's another section in this report that also speaks to Black and Hispanic families. So it gets into communities of color as well. So we'll share that in a subsequent email. Thank you for the question.
Thank you, Brian. I would still, if you do, I mean, given that the nature of the offering, I would think that we also have income levels. And I just think that's a good cross check to the community level statistics. So, but I really appreciate you pointing us to that information. That's really helpful.
This is Matt. Maybe just a comment and a question. One is, so if we're basically, it looks like we're taking back out the ERA funds and replacing them with Green Bank funds. My recollection is weren't there reporting obligations for the ERA funds? So does that trigger any sort of obligation, or are those all long expired?
Jane, if you're on the line, would you mind replying to that?
Why don't I take a stab at it?
Oh, yes. Yep.
Sorry, I'm here. I was just on mute.
And it was really just I'm just raising it. I don't need the response because it won't mean much to me. But
No, we should be good because we do quarterly reporting to DEEP within 10 days after the quarter close on what we've done with the funds anyway. So this would be something we would have to show them for the reclassification, and then they use it for the federal reporting. So we're good.
Great. Okay. Thank you.
This is Binu. I have a question. Actually, it's a follow-up question to Vicky's question. The percentage of vulnerable communities, are you looking at the full, when you're reporting the percentage, is it the full universal set of communities? Or is it, I guess it's how many have received the Smarty loans, right? So do we know what is the percentage of vulnerable communities in total and how we are hitting that percentage?
I think this is just done as a percentage of the loans that went to the vulnerable communities. I don't know the overall larger percentages of how many communities are deemed as vulnerable communities.
Yeah.
I think that's what you're asking. I'm happy to take that as a follow-up and circle back with you.
Thank you.
Great. So more to come on that in early 2022. So the next item is the Smarty and environmental infrastructure piece. And so just the quick note on that is similar to the error restructuring. This is a just a notice that in February 2022 at the next meeting, we will be presenting a more formal proposal to the deployment committee to expand the list of Smarty loan measures beyond the 40 that I had mentioned previously across the different categories of home performance, HVAC, renewables, and water heating, and health and safety, to include the other categories that are now part of the Connecticut Green Bank's expanded scope, to include environmental infrastructure. And so what we are doing currently is we have formed an internal working group led by Sergio and his team, and I participate on it as well, to assess what are the new measures that that we can and should add to the list, and which environmental infrastructure categories do those measures tie to. And the categories, again, are things like parks and recreation, land conservation, agriculture, water, waste and recycling, and then environmental markets. What are the technical requirements? So for all Smarty measures, in order to qualify for financing, those measures need to meet specific technical standards. So what are the industry standards that we should be meeting? Who are the contractors that should be participating in the program? And how do we identify them? Are there trade associations or other networks that we can tap into? And then what licensing and insurance requirements should those contractors have? The Connecticut Green Bank already has a very close working relationship with the Department of Consumer Protection, and we've continued that through the Smarty program. So we've already introduced this topic to them, and we'll be working closely with that group to understand what licensing and insurance requirements we should impose. And then also we have an inspection process as part of the Smarty loan. And so we are working to identify what inspectors should we add to the team in order to be able to assess potential projects. I will say what we've done so far is I introduced this topic to the residential committee of the EEB. I believe it was last week. We've are planning to do a larger contractor announcement to our contractor network just to solicit some feedback. And we are, just working to kind of assess what potential measures. And these are right now, sort of everything is on the table in terms of what we would add. Is it, roofing? What we've heard from contractors is siding, things like siding that would allow for example, siding, they said, is a barrier for wall insulation projects where the customer might turn down a wall insulation project because the contractor has to install the insulation from the exterior of the home. It affects their siding, and they prefer not to do it because they don't have the funds to then redo that siding, and that's not something that can be financed currently. So we're kind of looking into everything, and what we'll be doing because the deployment committee is the body responsible for approving any additional measures into the program. What we plan to do is come to this committee in February with an initial pass of measures, and then likely have it be an ongoing process throughout the year and so on, as new measures come to our attention, and we're able to provide the proposal for you. And so with that, I think that ends my slides.
Okay, having trouble getting to my unmute. Were there any questions about item 4B? All right, hearing none, we'll move on to agenda item number 5. And Bert Hunter, Executive Vice President and Chief Investment Officer, is going to lead us through this agenda item.
Actually, who will be presenting today is Louise Della Pesca, who's on the line right now. Thanks, Louise.
Thanks, Bert. Thanks, Louise.
Thanks all. So I'm presenting today, on the Skyview facility amendment. I just wanted to give a bit of information on Skyview before I started, and also the facility that we have had in place with Skyview and since March 2020. So Skyview is a renewable energy developer operating nationally, but mainly between DC and Boston. They've been around since 2008, and it's a sizable company with net assets in excess of $50 million. They operate over 150 solar facilities. And we've been working with Skyview on a term loan facility since March 2020. And the current commitment size of that facility is $7 million. And Skyview has a special purpose vehicle, which is the actual borrower of that facility. And that SPV draws down on the $7 million facility periodically in order to finance the development and the longer term financing of solar power purchase agreement. So we call those PPA projects in the state of Connecticut. So Skyview has been drawing down on this facility since we put it in place. And as a result, 35 projects have been financed, 35 PPA projects. And so far, $4.9 million of that total $7 million commitment has been deployed. The reason that coming to you today is to talk about an opportunity that we have to expand the remit of that financing facility so that we could also, as well as financing solar PPA projects, also finance energy storage solutions projects. So Skyview is developing a pipeline of 30 or so energy storage solutions projects in the state of Connecticut. It's doing that because as of January 1, 2022, there is going to be an incentive program for energy storage projects, of which Connecticut Green Bank is actually a program administrator. And as a result of this incentive financing that's going to be available, Skyview is developing a pipeline of projects that it hopes will take advantage of that incentive program. So there's a new technology that we could finance under this facility, and we also would like to expand the commitment. So at the moment it's $7 million, and in light of the opportunity to develop more projects, in light of the opportunity to develop energy storage projects, we're also would like to be able to continue financing solar PPA projects, because Skyview has a healthy pipeline of solar PPA projects, and we would like to continue the relationship and continue the uptake of this facility. Next slide, please. So here is a simple transaction structure diagram, which I'll talk you through, and it's how the capital is being used by Skyview. So Skyview has a special purpose vehicle, that's the borrower. Cephia Holdings is one of the Green Bank entities that we use to develop solar more generally, and it is deploying a term loan to the SPV. The SPV is the sole owner of solar PPA projects, so there's no other there's no other lenders involved in this arrangement. It's only the Green Bank that's involved, and we are in first position, so not subordinated to anyone. The SPV owns numerous projects, 35 so far as mentioned. Each project has an off-taker, for example, municipalities or small to medium-sized businesses. Those projects are solar facilities that are generating kilowatt hours, which are purchased by the off-takers, and that generates revenue for the SPV. The SPV uses that revenue to make repayments on the debt to Cephia Holdings. Next slide, please. So the existing portfolio that we have in place is 35 financed projects, 7 of which are schools, sorry, 12 of which are schools and 7 of which could be considered critical facilities, for example, police stations or firehouses. And of those 35, 1 is geographically located in an underserved community at the moment. Skyview does have a healthy pipeline, and there are 5 contracted projects, so that's where actual contracts have been signed to develop PPA projects, 4 of which are schools, 1's a critical facility, and there's more of those projects are in underserved communities, so there's 4 in underserved communities. Then there's an RFP pipeline, which is has a lower probability of coming to fruition compared to a contracted pipeline. But there's 6 projects in the RFP pipeline, and 3 of those are in underserved communities. Next slide, please. So I'm going to kind of switch gears. Those last 2 slides then were focusing purely on financing solar PPA projects. But as I mentioned at the start of the presentation, we do have this additional opportunity here to finance energy storage solutions, ESS projects. So thinking about, this is a new technology for us to finance. So thinking about what controls we would want to put in place, we would only want to finance ESS projects that are participating in the Connecticut incentive program. And that's because then we have confidence in the integrity of those projects, because there are rules and regulations associated with participating in the incentive program. For example, they have to use commercially available technology. The equipment has to have 10-year warranties, and the projects themselves, the ESS projects, have to be reviewed and approved by utilities. So all of those things as lender give us comfort. The changes that we're requesting approval to make to the debt facility are, first, to increase the total commitment from 7 million to 10 million. That allows us to finance the energy storage solutions pipeline as well as the solar PPA pipeline. And secondly, to widen the remit of the facility itself. So instead of just allowing us to finance solar PPA projects, it also would allow us to finance those storage projects. And we would structure the financing of those as partly in construction style financing, which the construction portion of the debt would be repaid by the upfront incentive that is available under the Connecticut incentive program. And then we would also finance those energy storage solution projects with term debt, so a longer term, for example, a 10-year maturity debt for those projects as well. Next slide, please. So the operational risk associated with this senior secured loan facility, essentially we need to ensure that there is enough revenue of being generated by the projects that we're financing to make debt repayments. That depends on how well those projects are performing in terms of producing kilowatt hours. We ensure that we have a fixed way of doing diligence on those projects to ensure that they're using, for example, what would be termed tier 1 equipment, and that there are reasonable production expectations associated with those projects. And we can actually see the performance of the projects that we've financed is very good. They achieve between 95 and 105% of their expected production, so that gives comfort. We, the Green Bank, have actually been developing these exact type of assets now for 6 or 7 years. So as a developer ourselves, we're comfortable with the asset and performing diligence on them. We stress tested cash flows, so we've looked at how much a project would have to underperform but still be able to cover the debt service payments, and at 90%, which is the 10% underperformance, there'd still be a healthy debt service coverage of 1.15. Has to go all the way down to 20% below expectations, which is quite rare, in order to hit a debt service coverage ratio of 1. Next slide, please. The default risk associated with the senior secured loan facility. The way we mitigate this is sizing debt, so that the debt service coverage ratio is 1.3. So it's kind of linked to the previous point. You're providing a healthy buffer in case the project that you're financing does go wrong for some reason. And we have an advance rate of generally around 70%. So we're not sizing debt so that if we were to have to take ownership of a project due to a default, we're ensuring that the amount of cash flow that would be incoming to us as owner is far higher than the debt that we originally advanced. The downside scenario then, if we were to take ownership of the collateral, we would subsume the projects that we financed into our overall portfolio. We do have a portfolio of around 20 megawatts of these exact type of assets. So we are very comfortable asset managing this type of project. This is for the solar PPAs. We do have a contracted operations and maintenance provider for our own portfolio. So if we were to have to take on more solar projects into our portfolio, then that would fall under our own operations and maintenance program. Next slide, please. And this is the resolution, which, just to remind you of the request here, the deployment committee is being asked to recommend to the board. The board meeting that we would like to take this to is scheduled for December 17th. So we're today asking the deployment committee to recommend to the board to approve the amendment of the Skyview debt facility to increase it from 7 million to 10 million, and to allow us to be able to finance energy storage solutions projects.
Okay, thank you so much, Louise. Do we have any questions?
This is Matt. I have, well, two. I will ultimately have to abstain from voting on this because I have projects that Skyview's on the other side of. But maybe a general question as we get into this co-administering the battery storage. Do we need to look at whether we have any sort of, are there any sort of conflict of interest issues if we're providing the, financing facility for someone who's, applying to the program and we're also administering that program? I mean, I don't know. I guess in some ways it seems similar to the PPA setup, but given that these will be not necessarily our funds, and I don't know what the agreement is for co-administering, but I just want to raise that as should we take a look before we expand this facility? And two, I think I raised this last time, is I know this is sort of a special facility that other people can do it and others really haven't, but do we periodically check and see if we're crowding out funding, not crowding out, but I mean, is there funding, private funding that's available to do what Skyview is doing? And is it the best use of our funds?
Matt, this is Brian. Why don't I take the first question? And Louise, you want to take the second, or you want to take them both?
I can take the second one. Thank you.
Okay, let me take the first real quickly. Broadly speaking, the Energy Storage Solutions Program is seeking to achieve deployment targets. So in the first 3-year cycle, it's 50 megawatts of residential and 50 megawatts of commercial and industrial. So there's a deployment target. That's great. But the Public Utilities Regulatory Authority has set, more importantly from their perspective, 2 overarching goals. One is that on the residential side, no less than 40% of the installations go to low-income and distressed communities. So the DECD defined distressed communities. Actually, I think they use the environmental justice definition, which includes the DECD community. So they have a Justice 40 target. The second is they want to ensure that storage is reaching those end-use customers for resilience purposes. In the event that the grid goes out, battery storage can come and provide some durational relief to those facilities that install storage. The Green Bank, as the co-administrator with the utilities, has put forth a marketing plan to Pura, essentially stating that our focus in the program is to ensure that the program achieves Pura's objectives of resilience and Justice 40. And within that marketing program, we include all of our financing programs, as well as the Green Bank Capital Solutions. So we're making our own open RFP an opportunity for capital providers in that market, with the focus on serving vulnerable communities. So we've had several conversations with potential submitters into that program who would service vulnerable communities. So we take your point. That's all to say that we're focusing in on trying to ensure that we achieve beyond the deployment target. The market will hit the deployment target, but we want to ensure that the blend or the makeup of that market brings in vulnerable communities and is deploying batteries on resilience areas, which includes, like Louise was speaking to, critical facilities, grid edge customers, small business customers, and those customers that currently use fossil fuel backup. So I believe we're in good shape there. I don't know, Bert, if you wanted to add anything, or Sergio, if you wanted to add anything on that one, and then we'll move to Louise.
No,
Right. If I could, yeah, no, I think that's great. And, you know, I support that part. I guess what I was more focusing on, and I'll just say it differently, is there the potential for an appearance of preference or impropriety if we're going to be, and I don't know how the program is going to be administered, but if we're going to be essentially approving projects that are also proposed by entities which we have a financial relationship with. That's more what I was getting at, not what level. Although I do like the idea, and maybe something to think about if Skyview is going to be working in the communities you mentioned. But I was more just asking whether there would be some appearance of impropriety if we had thought that through, of having that financial relationship and then potentially administering applications from our essentially partner.
Yeah, Matt, I think it's a very good point. And I guess I would just say that the investments team has not made it a practice of stepping over the line into the incentive program domain in that regard, in terms of, you know, approving projects. But yeah, and I would think that practice, we can enshrine that practice, formally in our operating procedures or whatever, Brian Farnan thinks is say appropriate, for our governance, for that. But it's the approval of those transactions, whether we're talking about RSIP in the past or this battery storage, the connected solution storage program going forward. It's very fact-based, meaning it's a very objective process, whether projects are approved for the incentive or not. You either qualify based on the criteria that's been established by PURA, together with the guidelines that are established by the utilities in the Green Bank, or you don't. And perhaps Sergio Garcia Sergio Carrillo could speak to that, because there's been a lot of work that's been put into those guidelines, and they're very fact-based. I don't know, Sergio, I don't know if you want to speak to that momentarily.
Bert, I was going to say just what you said. It's going to be a very objective process. We're not going to be approving the project per se. We're going to be approving the incentive, right? The upfront incentive. So we have no influence, no way to influence the decision of whether the project gets approved at the EDC level or not. We're just approving the upfront incentive. And as you just said, it will be very objective. There's a list of requirements, and as long as the applicants provide all those documents, the upfront incentive will be approved, right? And that's our role in the administration of the program.
It's very much.
So I feel very comfortable with.
This is Brian. I do see this very much as a programmatic approach. I do think, just from a belts and suspenders approach, maybe we could bring the final approved battery storage program to the board for an approval, even though it is, approved through PURA and is kind of a statutory, edict onto us. It may not be a bad thing to present that final program for approval.
Okay, well, that's fine. I don't want to make more work or take up time. I guess I just want to make sure, we're always looking at the outside view. As long as, smarter people than me are looking at it, I'm happy with the answer. I just, like I said, I just didn't want us to have this come up later and not have looked at it. So thank you. Those answers are more than enough, and I'll defer to you on whether you want to bring the battery storage program to the board or not.
Folks, this is Vicky. So sorry, my colleague at home today is causing some background noise, but I do want to I'd like to weigh in a little bit here too. I think I share some of the same concerns, and I guess it's unclear. I'm not entirely clear why we feel like we need to have what seems like an out-of-market solution versus just having the market-based solutions. What specific goal are we trying to achieve by doing that versus just running the whole program through the RFP process? And I also have a concern about if we're making it, if it's making it less competitive for others and providing less opportunity for others. Especially, this is not a Connecticut-based company. It's a very large corporation. So I guess I'm trying to get to the bottom of why we feel we need to do this particular thing in addition to the more market-based approach.
Can I ask you to explain what you mean by a more market-based approach, Commissioner?
And, this may be me just not understanding how this works, but, my understanding is this is one approach to reaching to achieving the storage goals, but that we're also going to have, an RFP, right? That folks can bid into. That is going to be separate from this to help reach our, for this participation in the storage program. Is that right? Am I missing something here?
there's the incentive program,
Okay,
and so that's totally separate from
separate.
the incentives cover a portion of the capital cost, depending upon how they're installed. If they're paired with solar PV, then under current federal guidelines, they qualify for investment tax credit as well as accelerated depreciation, but that still leaves a gap of capital requirements. Some of that is made up for by the owner of the equipment themselves, just as solar PV is, and there's some portion that is funded using debt quite usually. So that's what we're talking about here. Is we're talking about the financing side of the equation. That's what's before the deployment committee right now, not the incentive side. It's the capital side, the debt side of the equation, not the incentive.
Okay. All right, thank you. Any other questions?
I think that there was a question from Director Ranelli about about whether we were crowding out. I don't know, Louise, if you had some thoughts on that you wanted to express.
Thanks, Bert. I think to your question, are we periodically looking at the market to see who else is providing this type of debt financing? We're not doing a kind of formal exercise to look at anything like that and compare ourselves. But equally that means we're not trying to undercut anyone with our pricing. We're not trying to be cheaper than deliberately cheaper than the private sector here. We get some comfort from the feedback that we receive from Skyview in this case, which is that they're keen to keep using the facility, and one of the benefits of the facility has been that we, the lender, are just very knowledgeable about the asset that we're financing because we own it ourselves, and that just means that we have a smooth due diligence process. We're able to move quickly in deploying capital, which altogether helps them deploy more clean energy in the state. That's how it contributes, I think, to the wider goals of the Green Bank without specifically crowding out the private sector.
Okay, well, thanks. I wasn't thinking we were undercutting. I just didn't know if the other capital providers are mature enough that there's lots of money, for example, for solar out there that they could get, and we could redirect this money to more like maybe what Brian even referenced, sort of a battery storage in distressed municipalities or something like that, where funding might be harder to come by. That was the gist of it, but I don't want to belabor the discussion. I understand, that we understand the asset. It's a good place for us to put money.
Right. What I would additionally say is that we have some ongoing discussions right now with originators of battery storage that are looking to do just what you're speaking of, and so there are additional opportunities we're looking at with a specific lens on low and moderate income communities. So, those are through our Capital Solutions program, which the board approved last year, which is to try to make available Green Bank capital to encourage more financing in those areas specifically.
Okay, thanks.
Okay, so any other questions or do we want to move for resolution 2? Anyone?
This is Lonnie.
This is
I move.
Binu. Second by Binu.
Hi, Banu.
Hey.
All in favor?
Aye.
Aye.
Hi.
Abstain?
Aye, Matt.
Any nays? All right. With that, I think we're on to agenda item 6.
Okay, thank you, Commissioner. Yeah, this next item does not have a resolution associated with it. And the reason is because we are not ready to lock down the particulars. So given the timing, we'll be going directly to the board with this transaction as we expect to close it prior to the end of the year, as will become apparent in the presentation that I'm about to give. But this relates to the Small Business Energy Advantage program, which is a program offering by the electric utilities Eversource, as well as United Illuminating and the gas companies in the state. In particular, what that program does, it provides incentives as well as financing for those projects that are incented by those utilities using a 4-year loan at 0% interest. And this is for energy conservation measures, and it's limited to customers in Eversource's case that use less than 1 million kilowatt hours annually across their Connecticut properties. So our arrangement is with Eversource only, and this is a partnership that was put in place with Eversource as well as Amalgamated Bank 3 years ago to provide capital for the loans that are booked through Eversource's program. The goal of this arrangement was threefold, and the first was to reduce the cost of capital to the SBEA program, and therefore reduce the ratepayer cost of the interest rate buydown, because these are 0% 4-year loans that are used to finance the improvements. Previously, the cost of capital was very high. In Eversource's case, when we started out, it was close to approximately 10%. And with the lower cost of capital, we were able to save at least 600 basis points. Often 600 basis points, 100 basis points is 1%. So we brought it down to less than 4%. We were also, the other goal was to increase the availability of capital. There was a bit of a challenge internally for Eversource to devote more capital to this program. I wouldn't say it was a matter of availability of capital. It was a matter of desire, whether they wanted to be in the loan business or not. And that gets to the third goal, is that by doing the loan purchase agreement, which I'll describe to you more, it gets these loans off of Eversource's balance sheet and out of the lending business. So the partnership has been a success on many fronts. We've done this with our partner bank, Amalgamated Bank. Amalgamated Bank was selected by way of an RFP that was brought forward by Eversource. And so we, at the time, this is going back to 2018, we winnowed through a number of proposals, and Amalgamated Bank was determined to be the best one, and we moved forward with them. So the structure has provided more than $72 million in capital to thousands of small businesses, municipal and state customers, and the CGB, the Connecticut Green Bank investment, has been over $6.5 million. The 3-year agreement we entered into pursuant to board approval in 2018, that agreement will come to renewal at the end of this year, and so all of the parties are seeking to renew the arrangement for a further 3-year period. So next slide, please. This is a structure diagram of the master purchase agreement arrangement. You see Eversource on the left. Eversource's role in this whole arrangement is they have a number of small business energy advantage contractors that they work with, and those contractors source the project opportunities, which ultimately turn into loans which fund those improvements, again, for a 4-year period at 0%. Periodically, what will happen is Eversource will present a portfolio of loans to Amalgamated and Green Bank, and under the master purchase and servicing agreement, Green Bank and Amalgamated Bank purchase those loans at a discounted price, and the discount price reflects the interest rate arrangement under the master purchase and servicing agreement. And then over the next 36 to 48 months generally, and some of these loans do prepay. Sometimes the commercial entity desires to prepay the transaction even though it's a 0% loan. So over that period of time, Eversource will return the payments that they collect from these customers to Amalgamated and Connecticut Green Bank. We are in the subordinated position, which assures that Amalgamated will get their full amount of exposure repaid. We, on the other hand, are looking to Eversource as agent for the Connecticut Energy Efficiency Fund to reimburse us for losses using a programmatic set-aside that they have for loan losses. And we actually have recovered delinquent loans. The process is, if after 90 days of non-payment, it looks like the customer is not in a position to bring that current, then we issue a request to Eversource to process a recovery for us, and then we turn the loan back to Eversource, which in turn turns it over to their special servicing, third-party special servicing area, and then the Green Bank is out of that particular loan, and that continues until all the loans are recovered. Again, that has been done for $72 million worth of transactions of loans at a gross value, and a little bit more than 2,700 loans, and there have been 10 loan purchases, including the one that has been approved today. Next slide. And this is a general arrangement. It's currently a $65.5 million facility, with Amalgamated Bank providing 90% of that, or $59 million, and Green Bank providing the balance. Moving forward, the Green Bank is going to provide a little bit more, 20%, with Amalgamated Bank providing 80%, and this is going to be with some flexibility. So you'll notice that the figures down below that, which says CGB 30 million and Amalgamated Bank 80 million. So in theory, a total facility of 110 million. But this is, it's not really clear exactly how much would become outstanding based on the loans presented. We're engineering some flexibility in the arrangement just in case Amalgamated Bank chooses, for whatever reason, to not extend additional credit, whether it's because of a 7-year loan versus a 4-year loan, or because a particular municipality might not have a credit rating that sits well with their credit approval process. They have not expressed any of these reservations in particular, but what Green Bank wants to make sure, because we're trying to meet the request of Eversource as far as their programmatic flexibility, which gets to their deployment goals for energy efficiency throughout their service territory, is that we can meet their programmatic objectives, particularly for advances for state projects as well as municipal projects. Next slide, please. Oh, it seems to be it. So that's really the gist of the way the structure works. There was a diagram in here, and I think that unfortunately it seems like this is the deck that was picked up prior to that change. Could you go back a slide or two? We seem to have missed the structure diagram. Oh, no, that was it. That was it. Nope, we're good. Okay. If you rest on that screen, that'll be fine. I'd open it up for any questions from the committee.
Thank you, Bert. Are there any questions? Okay, thank you so much for that update. And now we'll move on to agenda item number 7, environmental infrastructure programs updates. And that's turning it over to Brian.
Great, thank you, Commissioner. So we are running over. Rather than spend some time updating the deployment committee in detail, I would say broadly that we are having a lot of fun digging into our new scope expansion. Ashley Stewart and I are having a number of conversations with nonprofits, investors, and others, public and private entities around parks and recreation and land conservation. That is one area of focus given our environmental infrastructure definition, with the lens across all of these areas of justice, environmental justice. So we're asking questions of stakeholders how they think about Justice 40, vulnerable communities within the context of their work. And we also ask them about climate adaptation and resilience, because our mission is to confront climate change. So in addition to mitigating greenhouse gas emissions, how we adapt to the impacts of climate change and become more resilient is also a cross-cutting issue. So we talk in depth with stakeholders about that. I'll leave the slides with you all just in terms of some initial findings on land conservation. You know, quickly, land conservation serves both mitigation and adaptation goals to confronting climate. There are state goals for open space and land conservation. The state has a couple more years to achieve them. There are various state and federal funding sources, including more recently the bipartisan infrastructure framework that will bring $445 million of additional state revolving funds to the state, which can be looked at to support green infrastructure. So that is for DPH and the Treasurer's Office to look at, but really interesting opportunities there to drive more investment in land conservation, including a few really interesting environmental justice investments in inner city parks. So we'll leave that with you all. And just know that we'll do another update at the board meeting in December. We're plugging away, we're taking good notes. Our goal is to try to focus in on each of those areas, learn and apply our green bank thinking to the environmental infrastructure space. We're learning and we'll share those learnings with the board as we make steady progress. That was it.
Thank you, Brian. And finally, any other business? Okay, hearing none. Any motion to adjourn?
This is Matt, so moved.
And I'll second.
Oh.
All in favor?
Aye.
Aye.
All right, we're adjourned. Thank you all.
Thank you.
Thank you.
Thank you.
See you soon.